Welcome back to America's Retirement Headquarters, home of the Retirement Guys Formula, America's Medicare Associates and Retirement Tax Partners with Nolan Baker. 419-794-3030 is the phone number. The website is arhq.com. You know, Nolan, earlier we were talking about the investment methodology behind America's Retirement Headquarters. And I love the fact that that has been consistent through the years that I've been working with you and throughout the team, whether it's Connor or Dan or anyone on the team. You know, they talk about those strategies that are the same, and it's consistent throughout. It is a good standard rule of thumb, so to speak. But rules of thumb, we know, don't always hold true. They're not always best for everybody. We've spoken about the so-called 4% rule of thumb before when it comes to retirement withdrawals. That idea came out in 1994. And here's wealth manager Michael Finca on Yahoo Finance talking about it.
The 4% rule says that if you retire with $1 million, you should be able to spend $40,000 the first year of retirement and then increase that amount by the rate of inflation every year and then not run out of money in retirement. So it's judged usually on a 30-year time horizon. So if the money is still around after 30 years, so if you still have some money in the bank, then it's considered to be a successful retirement. You haven't failed. Failure means you ran out of money before, say, the age of 95. And there are a lot of aspects of the 4% rule which really don't make as much sense today as they did when the article was first written.
So, Nolan, what kind of reservations is Michael talking about here? And do you agree with him? How do you calculate retirement withdrawals?
Well, you know, being on the radio for the past 20 years, we have oftentimes said things aren't like they used to be. And I would think the 4% rule is falls into that category. There are, I think, some good takeaways that you can get from the 4% rule. Number one is it's in general, a reasonable withdrawal rate. When you think about building out a diversified portfolio, some people come in and they have what I would consider to be unrealistic withdrawal rates. You know, they think that they have a couple $100,000 and they can take out 10 or 12% withdrawal rate, and that's just kind of unrealistic. The thing I think that Michael has reservations about inside of there is when you look at that rule, they're looking at, the course of 30 years. And if you average the rate of return over time for 30 years, I think that 4% rule can make a lot of sense. The problem, number one, is what is called the sequence of return risk. So if somebody retires and they have the majority of their money in at-risk assets, that could be stocks, bonds, or things that are at risk, major market losses in the first few years of retirement can be a disaster using that withdrawal rule. The second, I think, is the issue of increasing withdrawals in a down market. So using that strategy, what they do is they increase the withdrawal rate every year based upon what the inflation factor is. I think a retiree needs to be conscious about what the outcomes are of the portfolio. And when you have at-risk assets, which most retirees, in my opinion, should have some at-risk assets for growth potential, there's going to be times when the economy, the market doesn't work out. Those might be years that you want to be a little bit thinner with your spending habits, maybe not increase it. Maybe that's not the year that you get that new vehicle. Maybe that's not the year that you take that big family vacation, take, the kids and grandkids and everybody on that trip. Maybe you wait until the year when things are achieving better than expected results and you're in excess. And, we might be in one of those periods right now with the economy, the markets, doing good for the last couple of years. The 4% rule also doesn't take into consideration one of your least favorite relatives, and that's taxes. Taxes for a retiree is often one of the biggest debts that they have. So if you have a traditional tax-deferred retirement account and you're thinking of 4% withdrawal rate, depending upon your tax bracket, you need to add another 10, 20, 25% onto that number to take into consideration the taxes that you're going to have to pay as you take withdrawals out of those retirement accounts. The other thing is that rule doesn't take into consideration is investment management fees and expenses. So it's very important to understand, what your fees and expenses are, what your total cost is, and try to do anything that you possibly can to get the, highest quality service for what is a reasonable price, but factor that in. The fourth area that it doesn't take into consideration, I think, is unexpected things like long-term care expenses. So we run a lot of financial plans for folks, and we look at that similar scenario. We look at, a couple thousand possible outcomes of what could happen in a plan, and it'll show us the probability of success. And somebody might have a 90% probability of success when we run the numbers, but then ultimately, if we end up taking one of the spouses and use the example of the spouse ending up in the nursing home, say the last 2 years of their life, it could take the probability of success from 90% down to 40%. The solution here, in my opinion, is to create what we call the independent income system. Within the independent income system is a way to create different buckets of money that are designed for different withdrawal rates. And if you're wondering in your situation, what is a reasonable withdrawal rate that you can get 90+% probability of success? If you want us to stress test your plan and figure out what are the biggest threats and dangers that you could be facing, that could be a risk of higher taxes. It could be a risk of a market downturn right when you retire. It could be a risk of a healthcare crisis. We can run that in our retirement team action plan. So if you have more than $250,000 of retirement assets and you want to know how to calculate your withdrawals in retirement time, just give our office a call, ask for that retirement team action plan, or you can just go over to the website, arhq.com, click on that button you see right there from the radio, that retirement team action plan. You can schedule that meeting right online, and we'll be happy to help you crunch the numbers to know what your withdrawal rate can be in retirement time.
It is the number one concern among retirees and pre-retirees, making sure their money will last as long as they do in retirement. No one really wants to unretire. And so the withdrawal rate certainly does factor in. That's going to vary from person to person. And truth be told, it could vary from year to year. Think of that rule of thumb, kind of like buying a car or, a house or things like that. Like you've got the base model, but you really want something customized specifically for you that you're going to enjoy. Same thing with the retirement plan. 4% is a great place to start, but you get down to the details, you may need more some years, you may need less some years. But again, there are things that are discretionary income, vacations and what have you. There are things that are necessities, and you want to make sure at the very least those are covered by sources of guaranteed income. To see how it all comes together, well, that is where the retirement team action plan comes in. And Nolan just said there, if you're interested in that, feel free to reach out, to give a call. 419-794-3030 is the phone number. It's 419-794-3030, or you can go to the website, find out more about the independent income system and the retirement team action plan at arhq.com.